Sorry, today we delayed. Very soon we'll be going into the agenda properly, please. Let me just do this. All right, we are good to go. Okay, so we're going to be starting immediately. Today we're going to be talking about how to analyze stock, how to actually analyze stock, how to know the right stocks to buy, what are the things you put in place to know the right stocks to buy. And that's what we'll be doing today. And it's going to be 40 minutes or even less than that. We're going to be a little bit fast so we can see how far we can go. All right. So we're going to start by checking we're going to check four parameters. We're going to look at the understanding. Let me zoom this so you see. Understanding the business, also how to analyze financial statements, and as well as evaluate ratio and valuation. We're also going to look at investment decision. So those are the four things we're going to look at. Anyhow, how far we can go today, we'll continue tomorrow. That will be it. So we're going to start from understanding the business. So when you want to buy a particular stock from a company share, the very first thing you have to do is to understand the business. And that is why we say you are an investor. If you don't understand the business, there is no way you would want to buy that particular business because it's like you're buying that business. So as an investor, you want to buy a company stock, you should understand that company, understand the business they're into. What does the company sell, or what do they produce? Are they services? Are they selling? Are they producing? Do you understand? So you will be able to understand where you are putting your money into, the industry you are putting your money into, whichever place you are putting your money into. Then you have to check who are the customers of this particular company. Now let's use, for example, a biscuit producing company, for example. You know that, okay, it's a biscuit producing company and they are producing biscuits and they are selling, and most likely it's going to be children or corporate workers that want, for lunch, those kind of fast food that will be buying it, and then you'll be able to tell the direction the market for biscuits is going, if it's going to be profitable for you or not. One thing you have to know, if you are buying a company's stock, have it in mind as if it's your business, because it's actually your business. You're actually investing money. So if at the end of the day the company start going down, automatically it's going to affect you because you have invested money. So you have to understand any business you want to invest your money into. You don't just jump into the stock market and any stock you see, you just put your money and buy because you want to. No, that is not the mindset. That is not the mindset of growth. That is not a sustainable mindset. You have to understand the business. So that is one of the way to analyze a company. We'll start by analyzing the business, right? By understanding the business. Then also, how does it make money? This is another essential part that you have to take into cognizance. How does this business make money? Sorry. How does this business make money? Are they making money from services only, or from both sales of their products, and maybe they have external other services they're offering? So you'll be able to tell their profitability by by the way they make their money, right? That is one. Then the last one here, within 30 seconds, if you can't understand the company, if you can't tell what this company is actually doing, then it's not a good idea for you to buy, because you have to understand the company you want to buy their shares. Is I'm going to emphasize much on this place. Now, the second thing after understanding the business is competitive advantage. Now, most finance experts will call it moats. Competitive advantage. The advantage this business have over similar businesses. You know that in business, the difference between the business that is doing well and that is not doing well is information and let me call it advantage. What this company has that the other one don't have, the privileges this company have that the other don't have. So if you're investing in a company, you have to check to make sure the company you're investing in has a higher hand in that industry. Looking at maybe competitive advantage, it could be price competitive advantage, it could be location, it could be a whole lot of things. Now let me give you an example. Dangote Oil Refinery came up and Dangote decided to be in Lagos. Now, so many persons will be like, why not put it in the north since you are a northerner? Why not put it here? Why not put it there? But do you know what? Dangote is a smart businessman and he understands what we mean by competitive advantage. So if you are buying a company and the company does not have any competitive advantage whatsoever, you know it's going to drain down. You know you are not going to make profit for a very long time. You know that company is not sustainable. So if you're investing, try and invest in a company that's sustainable. Now, if you look at Dangote company now, it's in Lagos. Why? Because Lagos has the biggest seaports, deepest seaports, and that is where the bulk of all the seaborne trade in Nigeria is coming. So he can easily import raw material and immediately get to Lagos. Is not spending any other money in transportation. Unlike when that business is in another part of the country where you have to use trailers or any other means to convey the cargoes or the goods from Lagos to that place, you know, it's an additional cost which is going to eat down to the profitability of that particular company. So you have to make sure that that business you're investing to have a competitive advantage. First of all, it has to be a strong brand. If you're investing, please much well for beginners. If you're a beginner in this stock and share exchange uh, uh, market, please, any company you are buying their share, make sure it's a strong company. If possible, go for the best of company in this in the industry you want to invest in. Make sure it's a strong brand. Make sure it's a brand that is well known. Why? Because of rug pulling. If you don't know that in crypto, there's what called rug pulling, where a company will liquidate, like they just pull out funds automatically. Your share or your investment has no value. In the aspect of companies is liquidating, they'll just liquidate, and then if you don't take time, you might not be able to get good money from your investment. You might invest, let's say, 100,000, 1 million naira, and at the end of the day, that's diluted to maybe 50,000. That is losses, and you don't want that. So you have to make sure that the company you're investing in is a strong company, so that in the next 3 years, the next 4 years, they are not going down. They are strong. They can stand situation, because everything is trend. Business is trend. There are good times, there are bad times. Who will have the bad time? Will that see your company you are investing into? Will they be able to stand the bad time? That is why you have to make sure that the company is a strong brand. Do you understand? So let's move to the next one. Let's look at cost leadership. Cost leadership. Cost leadership. Let's look at cost leadership. Cost leadership has to do with cost advantage. Company A and company B, for example, are doing the same business, but company A has to spend just 100,000 naira to get a particular job done. Why it will take company B 150,000 to get that same job done? What has just happened? Cost advantage. Company A has cost advantage over company B. So if the company you're investing in has cost advantage, it's a good indicator that that business is going to do well, because always going to be ahead. That is to say, profits. You're going to be making profits. All right. Now let's be fast. Technology advantage. This is the key now, please. Please listen to me, everybody. Technology advantage. We all know that we're in the world of AI, we're in the world of technology. And every business now, they are their services and products to become technology based. If the company you want to invest in has refused by any means not to integrate, not to, start switching to technology, please stay clear because they will not survive the market. I'll give you an example. Fintech came in and they came in with fast services. They came in with good interface of app. They came in with multitasking app that can do a whole lot of things at once with ease. You don't have to go to anybody. And at first, traditional bank, they were just looking until they start seeing the effects. Everybody will now digressing towards fintech, using fintech app. In fact, it became people's best option. And they saw that this is going to be a problem. And what next? They also integrated their own app to be able to meet up. And that is why you can see how traditional bank are standing. They will do okay. There's some other regulatory stuff that happened, but you see, your business that you're investing in or the company you're investing in should have technology advantage, should be inclined, should integrate technology into their processes. If the business does not integrate technology, I will tell you to stay clear. All right. Then another thing again in competition, in competitive advantage is the large customer base. A company that has large customer base will surely make profit. A company that has large customer base will surely sell. So we are true with competitive advantage. Please be, you can be writing it, you can take your writing material, you can be writing it. This is for competitive advantage. You can just write it. Now let's move on to the next one because of time. Now we're going to look at industry and management. And I'm going to stay here and say a lot here. Industry and management. Is the industry growing, stable, or declining? Now, in Nigeria presently now, we all know that the tech industry is growing so fast. Everybody knows that the tech industry is growing so fast. And if you look at some tech companies, they are making good profits, they're making good money, and investors are smiling. Why? Because the industry in general is growing. I'm not telling you to just go and see any tech company and invest. No, take your time and do your fundamentals before you invest. What I'm saying is, if the industry is growing, then we can say that majority of the company under that industry will also be performing well because the industry in general, when you want to calculate it, you're using each company in that industry and aggregating everything, averaging it, then you'll be able to tell that, okay, this industry is growing. So once a particular industry is doing well, there is the chances is high. In fact, there's not like chance high. The companies under that industry are also doing well. Let me not say all of them, but majority of the companies will also be doing well. So you now have to do your own fundamental on the particular one you want to pick. So when you want to invest, please first of all check the industry that particular company you want to invest with. Check the industry they are into and see where the industry is heading towards. If the industry is declining, then I bet you it will not take so much time that the company you want to invest into would also start experiencing decline in profits and all that, and it's going to affect you, right? Share value is going to start dropping, right? And that is it. So this is one good way to be able to do your fundamental. Check the industry. If it's growing, if it's stable, if it's declining. If it's growing, it's a good one. If it is declining, you don't have to invest. You have to just wait unless you want to take the risk. Then on that thing again is management track record. We all know that there are persons that are gifted in management, like to manage a company. If the management that manage particular company A and made that company the best are now employed to manage company B, we can see everything being equal. A company B will soon be the best. Do you understand? So after checking other boxes, management is one good one you check. There's a particular bank, I'm not going to call the name, or some of you know it, that was doing well, but now has been, I think, acquired. They first of all merged with another bank, but they couldn't even sustain the merger, and they were acquired. Why? I think most of you know the reason: mismanagement. The management were not efficient enough. They mismanaged everything, and everything drained down. I don't want to call the name. All right, so you have to make sure that the company you're investing into has a very good management track record. The management are doing well. It's not management that will prioritize their pleasure. Sorry, let me check what's wrong with this thing. Some prioritize their pleasure over investors' money. This thing is out. Just let me get this. Let me get this thing back. All right. Just let me get my slide back. It's not management that will prioritize investors, their own comfort over investors' money. Then another thing again, you have to make sure that you check when you are doing this stock something. You have to make sure that this company you are investing into has the mindset of growth. Some company don't have the mindset of growth by their operations. Please give me a minute. Let me search for this thing, please. All right. Sorry, the thing just stripped off. Okay, here we are. So we're talking about the management. Then also corporate governance. I think that one also has to do with management. So in general, the industry and the management is another particular indicator you should be watching out for when you want to invest in any company. Oh, let's go to this one has a little calculation, but we'll not do that today. Maybe tomorrow, or we'll do that in SGA group. For those of you that are here for the first time, please. This is IFES Growth Hub, and what we'll do here, we'll do financial intelligence. Everything has to do with financial intelligence, business growth, shares and stock investment. And I welcome you to this particular community. You are welcome. If this is your first time, you can just type your name in the comment section, put your WhatsApp phone number, and then we'll get you involved in our community, in our WhatsApp community. All right. Please, if this is your first time, type your name in this comment section with your WhatsApp phone number. Let's continue. Financial statement overview, income statements. Now, this particular thing, they are all online. You can get them online, so it's not something that is hard. You can get the income statement of your company online. And the income statement will talk about the profitability of the company. So when you want to do your fundamental analysis on any company, you have to get the income statement and see if this company is actually making profit or making losses. Because you believe me, if the company has been making losses in 3 years down, there are chances that it will still be making loss. So if the company is making losses 3 years down, you buy it, you will still make loss and it's going to drain your money. So you have to make sure that the company you're investing into is making profit for some time. Do you understand? So we know the company is in green, we call it is in green. It's making profit. So when you put your money will not just wipe away your money, you will still see your money. Right? Then you have to in the income statement, there are a whole lot of things. I think maybe tomorrow we'll do that. Maybe tomorrow we'll do that. There are a whole lot of things in income statement that you have to check in for, including cash flow, so many and many things like that. But just check the income statement. The major thing that concerns you now is to check the profit and loss. For year one, profit and loss. They make profit. How much profit? Year two, they make profit. How much of year three? Year four. Add it, average it, and you'll be able to tell if they are making profit or not. Then check the margin. Check the margin of profit that they made. Is the profit increasing over time? Did they make profit of, let's say, 100 million in 2020, and in 2021 they made 150 million, 2022 they make 100 and let's say 200 million? We know that okay, they are growing because the profit is increasing, it's progressing. But in a situation whereby they make 100 million in 2021 and 2022 they're now making 80 million, they're still making profit, right? But the profit was not up to that of the previous year. Then there's a problem. And maybe the third year they also made lower profits than even the year following. Then there's a problem. You have to pause and start observing that company. You understand? So there are a whole lot of things in that income statements. Maybe by tomorrow we'll dissect it, or we'll dissect it in the WhatsApp group. Then another thing you have to check in the financial statement is balance sheets. Balance sheet tells you the financial strength of the company. Balance sheet tells you the assets and the liability of the company. if the company has so and so billion in assets or so and so billion in liability. You all know what assets and liability means, all right? So balance sheet will tell you the particular strength of that company, the financial strength. A company that has a whole lot of assets, that the asset is more than the liability, we can say that company is a good one. I don't know what's wrong with this thing. Okay, we can say that company is a good one, but if the company balance sheet is having more of liability, you know what it means. They are going to be servicing that liability with the money they are making, and automatically it's going to affect you, the shareholder, because the share value will not increase, or it will increase in a very low way, like a very little increment. And even dividend will not be as much as you want it. So it will just be as if you are tying down your capital or your investment in that company, and you don't want it as an investor. Then the last one is cash flow statement. Cash flow talks about the real cash. And believe me, some company do this. They used to cook their book. I know people know the meaning of cooking book. They used to cook the book, like they used to touch it to make it look good. But the only thing that they cannot actually touch is cash flow. Cash flow. They can make the profits. They can manipulate things to show you that the profit is increasing. They can manipulate things to show you that they have assets, a whole lot of assets. But you see, cash flow is what will determine if the company is doing well or not. Please take cash flow seriously. When we'll be diving into cash flow, you see there's a way we calculate cash flow. There's formula for it. For those of you that want to learn the formula, it's formula to calculate cash flow. Cash flow is talking about the real money at hand, the real money, not money in assets or liability, not money that is invested somewhere, but the real money available to run the business. And this is what will not tell you if this company is actually profitable or not. So we have to take cash flow very, very, very serious, right? So all right, let's move on. Sorry, today. All right, sorry, please. This thing is actually giving me issue. So sorry. Okay, let's continue. Let me zoom this so you see. The next one we have income statements. Income statements. I hope you are taking notes. Please, you can be writing it. If you have pen, you can be writing it. These are the steps for the fundamental analysis. Income statement. Now, income statement has to do with the revenue growth, the net income, the net margin, and so on and so forth. Just like when I was explaining, that there has to be an indicator of growth over time in revenue, in profitability. Profitability has to be growing, like it has to be in the uptrend for you to know this company is good. And the net income is equal to revenue minus expenses. We all know that's right. So when you minus expenses from the revenue, we have net income, and that is what we're working with. Why net margin is net income minus revenue. In a situation where we have 20% margin, we can say that that company is strong. You understand this one better later. We have industry standard of measurement at 20% in this case is what we're using to measure. So the net margin of that particular company, if it is up to 20% and above, then that company is strong by the time you minus it. All right, so you will learn about that one this tomorrow. Don't to bore you with this. Let's move on to the next one. Then balance sheets. Okay, let's break down balance sheet. Balance sheet has to do with cash equals to flexibility, debt, which is risk, equity equals to assets. Now, if a company balance sheet has a whole lot of assets and then maybe minimal debt and all that, the company, if it does not have cash flow, might still be in problem. So it's not just enough for you to say that the company good has plenty assets and then you just jump in. You can have plenty assets, but once there is no enough cash flow, the company will still face problem. Why? These assets are not easily liquidated. And in business company, they need cash to run the business. They need cash to run the business. Expenses, as operational expenses, cash you have to be the one to do it. You can't tell them. You cannot. Okay, let's say you're running as a company, for example. Okay, let's use telecom company. The telecom company cannot go and tell the people operating the generator in the mast that they have assets worth hundreds of million, but they have not liquidated it, but they should find way to power it. They know they have to give them money to buy fuel or diesel to put in the generator to power those masts. And that is what we call cash flow. So they need this cash flow. So any company that is not generating enough cash flow, even though it has assets, might still be facing problems. So a company has to balance that. And then we say cash flow is operating cash flow minus the capital expenses and blah blah blah. All these ones are also going to we're going to break it down tomorrow. I don't want to go into the go to break it down. Now let's look at return on equity. Return on equity. Why you are checking doing your fundamentals. Return on equity is very important. Return on equity is very important. That is to say, that's the main money that is actually yours at the end of the day. If you invested 500,000, let's say 100,000 per unit, how much is returning back to you per unit? If you invest 1,000 naira per unit in that share, at the end of the business, how much is that 1,000 naira giving you? How much are you gaining? When you're talking about profit, you're talking about accumulation of each units together. So we're looking at the unit price now. How much is this 1,000 naira investing? I bought shares, 1,000 naira. I used 500,000 naira to buy the share. That's how much. You're buying about 500 units of the company. Now, after the company close business at the end of the year, and then they decide to do a financial statement, how much has that 1,000 naira fetch? As a business person or as an investor, you're more concerned with your money, producing more money for you. And this is where the calculation lies. Your money has to produce more money, right? If your money is not producing more money, there's no point you investing, right? You're investing because you want the money to double. You want the money to increase. So you have invested 1,000 naira per unit in 500 places. Now, how much will that 1,000 naira bring back? Will it bring back 20 naira? Will it bring back 100 naira? How much is going to bring back? That's what return on equity is talking about. And to calculate it, just use your net income divided by shareholders' equity. Right? Net income, that is after removing expenses, all the company expenses and everything, the remaining profits, the net income that's remaining, you divide it by shareholders' equity, or total number of shares that you sold. You divide it by it. So the amount you get will determine the profits each shareholder is getting per unit. And immediately you get 15 to 20% per unit, then we can say it's a good company. But this is you invested 1,000 naira per unit, and each 1,000 naira investing, you are getting about 20% of that 1,000 naira back. So let's say you invested 1,000 naira. Let's do the calculation now. 20% of 1,000 naira will be about 200 naira. So at the end of the close of sales or close of business, you are getting 200 naira per 1,000 naira. When you multiply 200 naira by 500, you're going to see how much you have been able to add to your business or to your share. That is the value that has been added. That is the capital appreciation. And over time, when this thing continues, it gives you a very good amount of money. I will have said, let's do that calculation. let's do that calculation. Let's see how much we're going to get. This is my so you're getting 200 naira per units by 500 shares. That's 100,000. So you invested 500,000 and now you're getting 100,000 naira. That is total money is now 600, right? That is a good one. And that is a good investment. And I think anybody will want to do that. Sorry, I have to go. Let me open this. Let me open this. All right. So anybody who want to do that, all right, 100,000 naira is like 20%, right? That's 20% for your 1,000 naira. All right, let's move on. Right. Now, let me find something before we leave this return on equity. They say beware of high debts bustling. Oh, they're right. Yeah. Beware of high debt boosting. High debt boosting. They actually can use debt to boost the return on equity. So you have to also make sure of that. Please, high debt boosting. If the company is using debt to boost the return on equity, it's not a good idea because it's not going to solve the problem. At the end of the day, they have to pay back that debt, and it's your money you're going to use to pay back that debt. All right. Let's imagine we're going to talk about that tomorrow. That has to do calculation. Most of this thing have to do with calculation. The time has gone. It's almost time. Let me end it in risk analysis. All right. In risk analysis, first of all, you have to check about competition. If the company you are buying has big competitors, if the competitors are bigger than your company that you are buying, then it's a problem. You have to watch out for more indicators. Exactly. So you have to watch out for the competition. I think with this risk analysis, you can actually make sharp, quick decision. Watch out for competition. Make sure that your company is not facing a whole lot of competitors. Or if at all they are facing, they are stronger, they are the bigger competitor. Regulatory risk. Make sure that your company is not standing in a situation whereby it will face regulatory problem. Because regulatory problem can make your company to go down totally. One regulation like this, and that particular business is down, and your money is down, the investment is down, all the money you put is down. So you have to make sure that the company is free from regulatory risk. For example, let me give you an example. Let's say oil company comes up and you buy their share, and that oil company is having issue with NNPC and all the bodies regulating the oil industry or the oil sector. If anything should go wrong and they seize their license and they stop them operating, automatically your money is draining down. Your investment is going to go down. So please make sure that any business you're investing into is not facing regulatory risk or regulatory problem. Now, we also have to look at disruption risk, disruption in the industry. If the industry is facing a whole lot of disruption, things are not balanced, everything they're just, avoid it for that time. Then also customer concentration risk. If they don't have, they cannot conserve us, they don't have good customer. If they have to always get customer by advertisement every time, then it's a problem. A company should be a one that immediately after the first advertisement, the customer that comes remain, and they're not doing new advertisement to get those customers again. Don't know how to explain this better for you now. How to explain it better now? There are some businesses that each sales they make is credit of advertisement or lead that they got. They don't have returning customer, and that is a problem. If the business does not have returning customer, it's a big problem. If it is one-time customer, because that means they will have to be spending more money to acquire those customers, and it's going to be cutting down on the profitability of that company. I will go to end it here. If you have been on this live, thank you very much. Please subscribe to Ife's Growth Hub, and also if this is your first time, please you can just type your name in the comment section, put your WhatsApp phone number, and we've added to our WhatsApp community. Thank you for staying up to this time. See you tomorrow.